using digital.
Right. Cheers, Mike.
It's like learning the offside rule or learning defence or learning midfield. You break all the skills up and then they fit together. So,
I agree with you.
yeah.
Although, so I just overheard the chats here around how to learn stuff and how to get better, which I kind of would summarise as do hypotheses for previous days, then go to the next and see if they work. I think it's a great way of doing stuff. It just highlights to you what you're, quite quickly you'll start working out what type of day you're good at predicting, which is always a helpful thing. At least then if it starts to look like, I don't know, a liquidation type day, if you're good at predicting them, then you can have conviction it's going to happen. I'd say of all the types of days that I feel most confident at predicting, it's probably a liquidation or a balance day. Balance day is generally easy. Trend, balance day. Double distribution, balance day. It's usually the easy one. The liquidation days, I also think do generally have quite a simplistic approach to them. The good thing about liquidation days is they're actually really enjoyable to trade and they're good. Balance day, you go, oh, it's a balance day. I may not get to do anything today, but it's going to be a balance day. And that's the kind of second step of it. You might be good at calling something, but can you actually do anything with it? Which is always the hard part. Right, okay. Ian, can I touch on Fed bond market auctions and their effect on the market? Yes, I'll touch on those in a little bit. Not seen a load of Fed trade plans. I've just seen one for Darius. I'll perhaps pull that one up in a little bit. Okay. Yes, I'll touch on auctions. Just to be clear, they're not Fed bond auctions, they're Treasury bond auctions. The Treasury issues the bonds, that's the government borrowing the bonds. The Fed, the central bank in any country, is independent, so they don't issue bonds. The central bank doesn't need to issue bonds and debts, they can just print money. But what they can't do is buy the bonds from the government, because whilst they are independent, there is an element that they are still sort of institutions, if you will. You can't be the person wanting to borrow money and then also the person who prints the money, because I would borrow tons of money if I could print it myself, it'd be great, but I can't. And as an individual, I wouldn't stoke inflation. I'm not that greedy. So yes, we will go and touch on those. Jason's put that he's not got, or doesn't feel he's got enough to have a plan for the Fed. What I would do, if you have no plan for the Fed, go into it, and this is how I started learning central banks originally, was whilst people would talk about all these millions of different permutations, try and pick yourself some kind of outlier or something that you know is likely to at least give you some information on and have an idea of what you're going to do with that. The simple one here is mega outlier surprise, they cut rates by 50 or they don't. That's a trade at 7 o'clock for you. Outside of that, I would suggest probably there's nothing. The other one, get to the press conference. He's likely to be asked about whether they will cut in December or not. That could be your trade, the answer to that question, or however they manage to try and extract that information out of him. Make that your trade. So just keep it really simple. You've got one trade at 7 o'clock, which is almost a guarantee not to be a trade, but you've got to be ready for it. And then you've got the press conference trade, which will be, does he give any indication as to whether December is nailed on, in which case it's generally going to be a dovish play, or is not going to happen, which will be a hawkish play. In reality, you're probably going to get a shade of grey leaning more so towards one or the other than you will definitive, but there's a trade on it. So, and yeah, if nothing else, as a way to learn, just go and do the trade. If you think that he's lent towards a no cut in December, trade it as if it's a no cut in December, which is tantamount to trade it like it's a rate hike, is the way to try and think that through. Because at the moment, the market thinks cut. If he takes the cut away, it's basically a rate hike. So think of it like that. Right. Okay, following on from market selection, this is following a conversation we had in here this morning. I thought I'd touch a little bit on structure before we cover bond auctions, because I've only just seen that, but we can do it. Right. We were discussing this morning, or particularly me and Peter was discussing this morning, about the whole idea of looking at market structure from a wider perspective and then moving this down. I thought Bund was a really, really good example of this. And this is what I call a kind of structure trade. With a structure trade, the whole sort of concept of it is you're not trying to find the exact same thing, which is where it differs from, say, what you call a playbook trade. You're not trying to find the exact same thing, but you're trying to find broadly the same structure of what's happened. The Bund over the last couple of weeks, or 3-4 weeks, has been a fantastic example of this. What the bund did over here was a bit of sideways, drop, sideways, sideways, drop. So it moved into distinctly different phases. The way I try and sort of look at a lot of these things is there's a broad direction, which is what you're going to see from your daily. If you get any bond up, I look at it on a longer time frame, like on a daily, bonds have broadly gone down. So your bias in terms of, in terms of a general directional view is more likely down. You can then bring this onto a shorter time frame and go, okay, well, what that would suggest to me is that if anything goes up, it's probably more short-lived than down. Down can continue, up is more of a kind of liquidation and short-lived move up before you run into some kind of resistance. And that's the sort of base case that I always have. What I'm then looking at, so if we take this being your sort of structure trade in the bund, that you've done very similar to what you did here, bit of sideways and then sell off, and then we've traded sideways. This is the point then where I kind of view the market as what I would call neutral here, rather than saying, oh yeah, we're going down, we're going down, we're going down. It is neutral. In the day time frame scenario, this could just as well go up as it could down. If it goes down, then you can believe in this being a more significant move. But from a day time frame perspective, I don't want to be too committed to it's going down, because if it's going to go up 60 ticks or so up to here or into the middle of this range, that is perfectly tradable and is something you probably want to be part of. So I don't want to get overly committed to, oh no, it's only going down. If it goes down, I think you can at least have a bit more conviction in terms of scale of move and a willingness, if you really wanted to kind of almost swing trade this and go, it's going down, I'm just going to hold this and we'll let it go. So it differs in the way that you might go about trading it. But this very much for me would be your kind of neutral zone here. On the same vein, if you come back into this, unless you come back in and go straight through, I would view this as almost back to neutral. That you're then into a question, like if you come back up and get stuck in here, we're then back into a question of up or down. And that's where it becomes very neutral, because the longer term broad direction is down, so it would suggest just back in and back out. But short term, it's tried to go down and come back in, therefore up. So again, I don't want to get myself too sucked into decisions, particularly when you're in this zone. Like, you're gaining nothing from this going sideways. All that's telling you is everybody else is like you, and they also don't have a massively clear view as an aggregate. There are some people in here who absolutely think it's going down and some who absolutely think it's going up, hence why you're stuck in a range. But the aggregate market view is it's not going anywhere and nobody's really sure. So you might as well go with that and try and pick your points where you think that's going to change. Once you've got to those points, you can then look at it from the perspective of, okay, if it is going to change, what do I want to see at these points? That's the sort of next key step to it. So I'm looking at this then here from the point of view of, well, if you're going to play this down, and that would be the bit in terms of my planning of what I want to do. If I want to play this down, where do I want to get into this trade? The obvious is to play the break of the low. But because that's obvious, I would view this as kind of your last chance, and you don't really want to be selling there. Well, sorry, not you don't want to sell there, but ideally you don't want that to be your first entry. That should be your kind of like last chance or add point. I'd much prefer to be doing that there for the sell than I would, or I'd much rather to be adding there to sell than I would to that be the initiation of my short. So then this brings you into, well, what happened at this low and this low, which also match each other. And then you've got these lows as well. So you've got quite a lot of lows all together here. They're great because what that does is it gives you chances to go, well, if it looks like it's going at the first low, go for it. Because if it breaks one and it looks like it's got the pace in it that you want, it will probably break the next. If it breaks the next, it's not far to the next. If it breaks that, you've broken them all. So that's kind of the ideal scenario that you want to be in around these areas, or as it breaks through those areas, rather than just waiting for the low. Upside, slightly different. You've got all of these very, very same highs here. So 92 would be me on the upside on that. Whereas the downside's a nicer trade. We'll talk about this in the later weeks of almost what I'd call a dominant trade. The trade that of all the trades you want to do today, if you get the chance, that's the one you want, the downside move, because you've got chances or multiple chances to get in. You've also got chances to add on, and it fits with the overall directional bias. So that would be kind of your dream trade, if you will. Upside trade, happy with that. I would be very happy to be trying to play the break of 92, at least for 19, and then really you're aiming for here. So what's that, 37 to 45 area? That would be your goal. Whereas this could break and trend. So I'd be leaning towards the sell-off if I had the, if I was given the option, I'd go for the sell-off.
Can I ask you a question about the breakout then above the highs? You said above 90 something. So yeah. So given that there've already been, there's been a bit of business done slightly before that.
Yeah.
Clusters, how would you play that breakout? Would you say, do you know what, on the same principle that you just applied to the breakout of the clusters of the lows, like if it breaks into out, where would you say? What's the right question to ask you? Why do you choose 97 as the level, and why not say a little bit higher actually, because there's already been some business done there and I want to see it break through?
My sort of main thought on it was, bar this attempt out, and I can't remember exactly what caused these. That's the reaction to the election yesterday. Yeah. That would then be, so was that Wednesday, Tuesday, Monday, Friday. So was that would have been the payrolls move, I think. Or I struggled to think that wasn't payrolls. Can't remember. Monday, Tuesday, Wednesday, Thursday. No, that was payrolls. So that was payrolls that took you up and reversed it. So on that basis, the only way that you've actually been able to get over these levels is because of some kind of news. And even with news that takes you over the level, it still can't stay there. So that's my reasoning for that. And the fact that whilst, yes, it's gone higher, it always seems to be 92 that it sticks at. That's the only sticky bit to it, that it has traded above there yesterday. But I think yesterday was kind of a slight, I don't know, if you want special circumstance, it was not quite the same. So that's why I go 92. I always look for a place where I can get in with a minimum target. So even though maybe I'm looking for up here, I've at least got a minimum point where I can say, well, that's my decision. If it gets 19 and it just dies and starts rolling back, I could give it up in the high teens and be happy with it. Whereas if you buy 19 on the break, it either goes or it doesn't. And if it doesn't, you're definitely losing because it's got to actually go against you before you know you're wrong. Whereas 92, you've got more chance. One, you can buy the break at 92, but two, if it breaks it and pulls back like that, you could also play that version. So unless it goes 92, 3, 4, 5, 4, 3, 2, 1, you're probably okay. That's why I like the 92. And also, it's hard to sort of define the thinking behind it, but you kind of broadly see that as the zone, and these are just little edges out. So what a guy called colouring in, on the idea that if that was your area, if you asked a kid to colour that box in, they go like that, or a young kid at least, and they colour outside of the box. So you kind of go, well, that's just them missing the edge of the box. Broadly, that's the box. That's just the colouring in. So that's another way that I try and sort of think about it. That's broadly where it is. You could do it and draw a profile across it as well, if you really wanted to, but I don't think that necessarily defines anything anymore. So yeah, if you draw a profile and the value area high happens to be there, I wouldn't play the break of the value area high. I'd want 92. So that would be the reason. I actually got it on a shorter time frame. What I'm looking for from a profile perspective, and you see then, I haven't moved all these levels. You see from a profile, that's 92 there. So it's through that high. You can kind of see from a profile a little bit more why 92 makes a bit of sense. That you've got the highs, the single prints, it was top of value yesterday as well. That's the 92. The bit with the downside, and I can't remember where I said the bottom of this box was. Well, I was looking at down here, so that's then 25. What's quite good about the profile here is that if you look, it was yesterday's low. You've also got that volume ledge and ledge on the TPOs. You've got a ledge on the TPOs a little bit higher, and you've got the bottom of value over here. So that gives you that extra bit that you could kind of go, well, I could probably have a go at the sell through yesterday's low and this volume and this ledge. If it goes through the ledge there, that would be the point to sort of start the attempt at a sell. So there's a lot more options on this one to the downside. Whether you play the ledge break, whether you play the break of yesterday's low, the break of these 2 days lows, however you do it, there's opportunities to go for it.
And where's the ledge, for the ledge on the 5th, where's that on the chart on the left?
So the ledge comes at 34. Oh, there you go, that's that level there.
And it's the bad lows to the left in the slightly.
Yeah, so this is only a 5 minute, but yeah, that's the lows of yesterday.
Yeah.
And then you've got, that was the day before, which had got multiple tests on it as well. And it's got loads of volume on it. So it kind of suggests there's someone holding that up. So you assume that when 34 goes, that's the tipping point. So then you've kind of built that idea of, well, I've got this structure. If it goes towards the downside, I'm happy to be short. Minimum you're going is to break the edge of the range, and then wherever you think there's scope to reach after that. Which then brings you down to the short time frame of how are you going to execute that. This is the thing you mentioned this morning. This was perfect in that you did a reasonably small initial balance inside of yesterday's range. You're looking at that thinking, this is just what I want. In fact, I should probably get the replay up of this. I'll do that in a moment. That's just what you want. You want it to do that nice small initial balance. So you look at that and go, I could have a shot at this on the break of the initial balance. So it's just giving you one more place to go for it. The nice bit about that is if you go for the break of the IB at 47, you go for that. If it fails at the first hurdle, you're still 10 ticks on side by the time it goes wrong, or maybe even 13 ticks on side. You know it's not working. You can afford it to come back to you, and at worst, you're going to take a little loser. You could give it up before that. For me, I would look at that and go, if I'm selling the IB break, if this goes here and comes back, I would still hold my stop above the open, just on the basis that if this is going to do the pullback and still go, that's a wonderful position to be short. So I don't really want to give it up, even though you might feel it's perhaps not right. If it just dribbles down here and completely dies, then it might be one to go, I'll give that one up and I'll try and sell the break of here, which is the other approach, that rather than say, well, no, I'm not getting out, it's 55s or nothing, or sorry, 55 or down here. The other way of doing it is if it doesn't look good when it gets to 34, you can give it up and then play that break. It just puts the onus on your ability to read the break as it happens, rather than go, look, this is my chance. I've got a good place, stick it.
Did you just say that you put your stop just above where it opened?
Yeah, well, because you got the open is on the bottom of value area low as well. So kind of, if you get over there, I'm really struggling for reasons why it's still a good idea. That incidentally is this little range here.
Yeah.
So there, and then the IB low is 45. So that, yeah, it would have been just that. That would be the IB low, I think. Yeah, about there. So yeah, you're playing the break here. If it goes like that, I'd be quite happy if it gets back inside that range. You're really struggling to say that this is still good, but yes, it might be a 8 to 10 tick stop. At minimum, you should be taking out the recent lows, which are, I can't remember where they were, 15. So even a 10 tick stop for a 35 tick winner is good. If it takes out 15, this could be a really big one. So that would be my reasoning to not give it up. But you could do that. You could give it up if it seems to die there and then go, okay, well, let's wait for the break of 34 and we'll have a shot at that. And if that doesn't work, we'll have a shot at the break of 25, wherever that is, and go for that. As it happens, it does it real quick and it gives you the full break nice and fast.
And the perfect pullback, the second chance to get in.
If you like technicals today, the Bund has traded it about as perfect as it could. It literally has done this, and then it's done this little sideways range. It broke above 90 and up. It has since gone back to 90 to the tick and gone to 34 and is now trading there. It's crystal clear at the moment, the Bund. It's almost one of those trades that if you, one of these markets, if you drew some lines, just buy or sell lines, someone new would go, God, this is the easiest job in the world. You just click, 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 and it's worked off all of them. I was going to say, there is an element that when you get markets get shaken up and you get a lot of volume, they do real simple stuff, particularly when you're in an environment, if you think about who's participating today, it's predominantly short time frame people. We've just had the election, we're going to get the Fed. If you are a fund and you have got a serious amount of money to manage, you're going to want to understand the outcome of the election and the Fed, and then you're going to make a decision about what to do. A lot of the people playing around today are short time frame people, and what do they look at? Charts and levels, and we're all looking at 34. Everyone's going to be looking at that, which means it reacts because, well, there's no one there to drive it through 34. You just end up with this wall of short time frame people all going 34 is where I want to sell. In fact, I don't know if it actually traded 34, it might trade 33, but it went nearly there. And you get a lot of that type of thing. It's a really, really sort of clean types of movement. I'll get the replay up in a moment, but that would be the bit that you're looking to try and do. Sell either the IB break or the 34 break. One of the guys in the office did it really well this morning. He got on that bit kept a bit on and then got back in. I don't know precisely where it got back in, but I'm going to guess either there or as it come down and sort of did this little consolidation and played the next leg of the move. By far the best performer in the office. So he made about 170 grand on it. Yeah, so it was a good day for him. But like that's exactly the type of trade that I would expect him to look for. He's very technically orientated, and these kind of day after day after day consolidation trades are the kind of thing that he's pretty inclined to go for. The IB break, hammer the IB break, sell it into the lows, and then get the flush out. What he's quite good at is, and I didn't see the beginning of the trade, but I would have had a reasonable guess that the majority of the money made would be that bit of the move, just there, the first flush, and then he'll have another go on the next leg, but the main bit's that first flush.
And why, and help me understand the rationale for why such a high conviction in the IB break today? I mean, could it not have just dropped a couple of ticks and come back? Would you, like, why, is it all the contextual alignment of everything else that means today it's now based on everything that's what's the word I want to use, the accumulated picture of pattern that set us up to this point is now so strongly for a break that that's why you're adding the weight to the context of
yeah, a lot of it's that you know it's coming. Yeah. We are, like you were saying here, it's coming. There's going to be a break. It's got to happen at some point. You can't sit there forever. So it's not the IB break today is the case that it's a small IB. So you're looking at that going, today's the, if there's ever a day to go for it, this is the one to do it. Yeah, I'm sure if yesterday it had sat with a tiny IB, go for it yesterday, but instead the IB was the entire day, so there's not a trade on it. But that's kind of the one where you're right, well, it's done the balance, it's ready to go. If it starts to go, you go for it and sort of play it, assuming this is going to go. And there's that aspect of you have to go, well, it might not, but if there's ever a good chance, it's probably this, and that's the kind of the sort of mentality around it. If it's going to do it, today's the day. And yeah, if it doesn't work, it doesn't. But if it doesn't work and stays here, well, you've probably got the same game again tomorrow. And okay, you're recovering a bit of a loss maybe. But also, like I say, if you go for that IB break, it's not often that you're going to have that it just goes tick, tick and back up and you end up stuck real quick. You would expect it to go. So you're kind of playing it on the basis that if you can get 15 ticks on side, you're safe. This is a winning trade. It's just the degree of the win.
I suppose, and to that point, if it does break the IB and fails to go, and it comes back and then it hits the midpoint, at that point you're thinking, okay, well now potentially the upside is on, right? And then you're then looking for, well, are we going to go up and are we going to break 91 level, 92 level that you're looking at before? Yeah, exactly. You've got that scope to go the other way on it as well. Right. Incidentally, the bun's just broken the 34s.
Yeah, it did.
There you go. It's done. Back, tick, up. So this is now the moment of truth for the bund. If it's going to go down, it's got to stay below here. If it goes up and gets back inside the range, it does make for quite an interesting day tomorrow. You could get the other way play and all the way through. So we shall see. I'll get the replay up on that one. How do we get it up? Incidentally, the S&P's opened gap up again. Could go gap its way into record highs now. Right. Let's have a look. What time is it? I probably should have had this one planned out this morning. Okay. Right, here we go then.
And to come back to the conversation we had slightly earlier about the importance of effective practice and learning the skills and stuff.
Yeah.
This would be a really good opportunity, I guess, this day when you can practice several different plays here, right? More than just this one move, which is fading the IB or sorry, joining the IB break, adding at the low, or waiting until you get to the break at the bottom, then breaking it there, then on the adding. You've got like 4 or 5 different scenarios where you can test and practice just on this pattern on this day.
Yeah, absolutely. I think that's exactly the kind of way you want to look at it. That you've got different skills to have a go at here. You've got the IB break with, and part of doing it is you start to get a sense of what it should look like. This is really slow actually. I thought it would have been a bit quicker than this. But one of the things you're looking for on a break, for me, one of the things I'm looking for is this has this kind of pulse down that is, kicks it down quite quick. That's got a little bit of pace, then you get 1300. That's then going to be your chance. So that's the kind of thing, you can't predict that. You don't know what's going to happen, but that's your prime one. You look at that and go, that's it, let's go for it. You fancied it anyway, and there's your chance to go for it. It actually seems to be sort of running away. And that's also part of why you go and practice these, the consideration of, do you really want to sell 39? Because if you're going to put your stop above the open, your stop's now up here. Yeah. Do you want to sell 39s? You know, what's your tolerance for it? If you think this is going through the lows and significantly through the lows and you're going to get this kind of liquidation out of range, yeah, it's not great. You're 6-7 ticks worse off than perhaps you would like to be. But it's always that toss up of, is it more important to be in? Because if you're not in and this just goes, you've missed it. So that's something that you kind of have to have planned out as well going into a trade like this, where you go into it and go, I think this, if you think this is, you know, your A+ trade, you go, well, if I have to chase this and just hit it, I'm fine with that, within reason. Because at this point, you're still above that 36, 34. So if it goes through there, you're all good. Yes, you didn't get a great price, but you're still in a good place. This is what the guy who did the trade, Simon, talked about in the past to me, about what he calls an execution zone. And the way he looks at an exact trade like this is that if you view the break here and the break here as your kind of key points, anywhere in there doesn't matter as long as you get short. Like, the goal is just to be short in between those 2 points, because if this trade is going to go, the value is huge, the loss isn't that much. If you're short here and your stop's here, that's a reasonably small stop for a minimum of here, and then who knows where beyond that. So that's the perfect time to take risk. It's the point where the trade already looks good and the cost of losing is, well, as small as it's going to get on the trade. Yeah, you can go lower. If you sell the break of 36, then you could put your stops like, you know, at 40, and you can reduce the size of your stop, but the payout gets smaller. And you wouldn't necessarily be wrong if you got stopped out on that. So the idea is, well, yes, it's not a great entry point, but you'd be happy to accept that it's not great because of what you're going to get out of it. Alternatively, like I say, you go, well, if I can't get 46, 45 on the break, I'm going to have a go at the 34 break and play it like that. So you don't have to be, you know, so rigid on it.
What time was the break of the IB?
That was the break of the IB, that little bit there.
Yeah.
And then it comes back. I'll let it play for a moment. It comes back, and this is where, you know, equally, if you, if you're going to replay it, do it from, you could do it almost from 8 o'clock, because that would then be the preamble before the break. It actually broke, I think, 8:03, and then it comes back and, you know, it gave you the perfect retest. If you wanted to sell, you know, if you were going to be tight about it and say, well, no, I'm going to be passive now, 46, 47, it got you them. Comes back. This is one of those, it puts you under absolutely zero pressure. The only pressure you've got on this is if you created your own pressure by chasing it down and hitting the low. But as long as you remind yourself that, you know, 47, you're not wrong. Your stop's up here. This is all good. You've just paid a little bit more to get into the trade, which is probably worth it. Then I think you're fine on that. And then the next bit, I'll show you. Don't know how it traded on the next bit, but it comes in like a minute or so. It'll be interesting to see how it does it. Incidentally, the Bund's just traded 34 and it's now on its way back down. So probably somewhere around the 10 area, I imagine. Right, there you saw it, just had that little kick there.
For the market profile charts, but these are not 30 minutes, these are daily.
The whole profile is the daily,
Okay.
each letter is 30 minutes.
Okay.
So this is then the point where you're getting right down onto this level. This again would be the point where I'd want to see, similar to the way it went through the IB, that it goes through that quite smooth,
Okay.
which it has just there. It's still not done it, for want of a better word, particularly nicely. It's not done it with that rush through, but equally, it's not come bouncing back either too quickly.
wash through that you would be sort of wanting to see? You wanted to see that to have confidence in the position you're already in?
One, that, and two, to add on as well, yeah. Yeah, and that didn't really do it. It kind of went there and it's just tick, tick. And this, probably exactly what I was talking about. You've then got the question of, if you don't think that's good enough, do you want to give up your short, or do you just go, no, this is as good a position as I'm ever going to get? Because the problem of giving it up, you can bank some money, which is always something a lot of people look at. You can bank some money, but if this then goes 34.28, then what? You possibly missed the entire move, or you at least are then selling bad prices, which could lead you to a stop back up here, which would wipe out whatever you've made. Is something to really think about. Like, how good is this position? If you think that's a really, really good position, you don't want to give it up, because if you give it up, you're never going to get such a good price again if it does what you think it's going to do. Obviously, if you get a good price again, well, perhaps it's not what you thought it was anyway, so how much do you really want it? That would be the sort of consideration, particularly on these bigger moves. You have to kind of sometimes just step back and go, no, this looks fine, particularly as it's now done a load of volume there. And now it starts to sort of roll. Once it starts doing this would be the point where you say, it's all good. Just, you've done the work, let it go. Yeah, if you want to sort of try and cover something, the obvious place would then be the recent lows. Just in case it ticks the low and bounces, you could try and like reduce some of the position at the low, just to give yourself that chance to get out down there. But that would be the point where now I'd be feeling quite confident on this. And then it just comes down to your own question of, well, how far do you think it's going to go? Which is wherever you think it's going to go. The hard bit in this one of holding and holding and holding is seeing it trade, what's that, 0.5 and then all the way back. So it's whether that comes down to what you think is going to happen. If you're playing this for the break, it's traded 0.5, you're through the level. I think that's the one where you go, well, I can give this up if it comes back above 15. The only way you'll sit through this is if you have conviction from here that this is going way down. If you've got that, then you can sit through the pullback. If not, seeing it come back 25, 30 ticks in your face after having been nicely onside, you'll start to talk yourself out of it. That's why I always say you have to have a target before you get in the trade. Because if you don't, that's so difficult to sit through.
So even if you have set, like, you prep and you like lower target, when it starts creeping back up, you just have to say to yourself, nah, I'm going down.
Yeah, that's the way you've got to look at it. You've got kind of, the trade is here to here or wherever you've got it planned out. So that what you can do is you can kind of look at it and go, well, I've not even got halfway to my target. The last thing I want to do is give up. Essentially, if you give up there, you're giving up, what, 20% of the way to your target? So you're 20% of the way there and you're going to give it up without ever being proved wrong. You have to look at it and go, no, but that's not the trade. And it's a trust in the process type thing. It's not easy to do, which is why for me, that's not the way I like to do these types of things. It's something that I've always struggled with, because I'll end up sitting through it here, go, no, it will go. And then it starts coming down again and it starts to die and you go, do you know what? It's back at 15. That was where originally I thought it might have gone anyway. And you end up basically just stressing yourself out and getting out of 15s. So for me, I've always looked at these and gone, well, if I can get the quick bit of the move, great, I'll take that and then try and get back in, because whenever you get a quick move, you would almost always get a consolidation phase afterwards. So if you're going to get that suggests it is going to pull back on you, in which case I'd prefer to be out down here, or at least almost all out down here, and try and sell the pullback than I would try and sit through it all.
And I'd say from experience also, it's better to, like you said, to scale out a target right at the bottom as you approach those lows. So you actually take the money off the table at the maximum favour, towards your maximum favour of excursion, rather than watch it come back halfway, end up scaling one out higher up, right, giving up all that potential profit and then sitting and waiting on it. And effectively what you're doing is reducing the profitability of that trade, because you're not exiting at a optimal location. You're then, the fear kicks in, which then makes you take a different course of action, and then you're reducing your overall size to your final target.
Yeah, and so what you end up doing is, if you do manage to hold it and it goes, what you end up, there's your 15s, what you end up doing is carrying a very small size all the way down here, which then isn't worth it. This is the difference between, say, the way I would do it and the way Simon does these things kind of very well, is he will do it, but you'll see it. You'll see some of them and it will come back and it'll get stopped out. You go, why didn't you just take it? But the process.
One of those trades that you said that just is when I'm in it, and
Yeah,
it comes back.
because the objective is, yes, he might get stopped out and it's going to cost him 10, 15 ticks. But the counter to that is, but when it works, he's got 80, 90 ticks out of it. So in the long run, it pays. But in the short time frame there, it feels horrible. But the worst thing you can do is reduce here. If you reduce there, in the long run, it doesn't pay enough for the ones that don't work at all. Because some of these will just go like that and you get stopped out. So if you're going to play the big one, you've got to be willing to go, well, I'm playing the big one. You'll get paid very well occasionally, and some of them will come back. Versus playing the smaller ones, you'll get paid more frequently, but less well. So you've got to balance, your personal sort of feeling on that and how well you cope with those types of things.
And then and then if you were to take off the 34 level,
Yeah.
when it pulls back, what's the question I'll ask you? Context is using order flow to read when the pullback has reached its peak or near reaching its peak without having visibility to the right level. Because it could come back to 34, it could have come back to 32, or could have come back to 30.
Yeah.
And then you wouldn't have the nice line across the chart to lean on to go all the way to the right to the pullback or let me now enter the short again. How would you go about reading the order flow? You didn't have the line on there to just give you some context of where is a reasonable point to load up on or to add to the short for the next rush down.
Yeah. If I had no chart,
Yeah.
I'd be looking at this in kind of pockets of, you've got where the volume forms here,
Yeah.
which is 12 back to 18. If I don't sell 18, I won't sell until 26 to 32, 31. So that would be my kind of next little pocket. And so without a chart, I would probably be thinking somewhere between 26 and 31 would be my place to sell.
So into the previous volume as it comes up towards the edge of the top of that high volume.
Yeah, so without a chart, I'd probably be looking at that thinking 26,
Yeah.
because you don't know that it's going to trade all the way through.
Yeah.
So kind of going, well, you kind of have to sell 26. If it goes into this range,
Yeah.
you can't give that up if it's trading 31. You should probably sell 31 as well.
Yeah.
So it would be a case of, as it comes back, what I'm looking at is, does it slow down? And do you get to a point where as it comes back, it struggles to actually push the offers out the way? And if it struggles to do that, that would be enough to then sell. So it's almost what I call it, the sort of the absence of something is more what I'm interested in than the presence. I don't need to see much, I just don't need to see buyers. And as long as you're not getting buyers there, you can go, yeah, okay, I can have a go at that.
Okay. Because the logic being, it's not like you've got people buying all the way up and then suddenly all the sellers turn on, they massively overwhelm it, right? There's sometimes that period of avoidance before something stops, and then there's a little bit of pause before something starts again, like the buying kind of runs out of its energy, and there's a little bit of time, however long that might be, half a second, 3 seconds, 4 seconds, before the buyers then say, okay, let's now start. Sorry, the sellers start, so let's start.
Yeah, you need to see the buyers just don't have the legs in it to actually get it up there. It goes up, it sits there, and then the sellers are going to look at that and go, okay, nobody is trying to push us out of the way, we can try and sell it now. This is then the move up, so this is the first test of that move back. So 26 would be the first point. So that would be the kind of, I'm never a big fan of just passively offering a level. The fact that it just went 26, just went bid straight through it, I wouldn't be so keen on selling that. It's easy to say now because I know it's going to trade 34.
Meaning what you would rather wait for it to come back down and then try to...
Just more that if it was trading up, I wouldn't just put an offer at 26.
Okay.
I'm never a big fan of doing that.
Because you don't yet know whether it's slowed down or not.
Yeah, you don't know. They're not just going to go tick, 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 fill, tick, 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 up, and you just sold it and just got run over. So I'm never a big fan of doing that. I want to see it trade there, fill to 26, the offer comes back, trade to 26, the offer comes back again. That would have put me off because it went tick, tick, tick. It got to 26 and it just went 300, bid 26, and that would be a point of going, whoa, I don't think that looks great. So probably wouldn't have sold 26 there. It's one of those, it depends how badly you want to sell it. If you wanted to sell that, you go, well, they bid 26 and it went offered 26, sell 25, and you kind of go, well, it's good enough if you want to sell it. And a lot of the time, order flow is that kind of case that if you want to sell it, you're not looking for loads, you're just looking for enough to say you can, which that is where I'd always lean towards a chart. If I want to be selling 34s, my tolerance for selling 34 is pretty low. As long as it doesn't look like it's going straight up, 34 is a sell. So it'd be one of those where you kind of get there and just don't plow through it and we can sell it kind of thing. I feel like I started that slightly off time. So maybe it's on this one. Again, I'm still not sure I'd put an offer there. One strategy I have and sometimes employ is if you're a little bit below a level and you think, well, I would quite like to sell 34. One of the ways you would like to sell 34 is if it does a quick ping to the level. So they're the ones that you could offer it, and then it'd almost be a case of if this just creeps and it goes bid 30, 31, then I pull the offer. If it sits 28 and it goes tick, tick, tick straight to 34, great, I'm happy with that because that's the sort of rush up. Unless you then find more buyers straight away, it's probably at least going to pull back and it may not go back again. So this guy's traded 30, 32, it's quite quick. Would I keep it there? Possibly not, just because it's not pinged it, it's kind of just drifted, particularly as it's kind of just sitting still there. So what I'm looking for now is what does it do at 34? How easy does it trade it? Because that move up was quite easy. That was, yeah, it just got slapped straight back down on that.
And there, now it's had that reaction, are you going to try and wait for it to ping back to 30, 31s, or are you just going to say, oh, do you know what? So
I'd have been, yeah, on that when it went slap, I think you'd sell 30 or 30, 31, whatever you could hit. As soon as it went bang, you could just go for that. Again, on the basis that you want 34, even if you were offered it, you never would have got filled anyway. So 3, 4 ticks worse off, yeah, it's not that bad. It's not great, but it's not all that bad to be in.
That's something to factor in as well, is also that until you really see the order flow, you don't always appreciate that there's actually not much liquidity at the perfect level, right? So if you bid her off at the perfect level, you might end up not getting filled because you probably need to bid her off slightly underneath it.
Yeah.
The bulk of the liquidity is a bit.
This is where back testing on charts doesn't always work, because a lot of things, like, look at that, perfect. And then in reality, you would have never got filled there. You just wouldn't have done it. So yeah, there is a lot there. Yeah, 25 lots, you're not getting that. And the only way you're getting those 25 is if you tried to sell it on the way down, you didn't get filled, you happen to be left at the front of the queue, and then it comes back, and now you're at the front of the queue, assuming you left the order there. But yeah, realistically, that's probably someone who got part filled on the way down. They tried to hit it with, say, 100, and they got filled 75, and the 25 got left on the offer. They leave it there, you're front of the queue. If it ticks it, you're in. Just be wary of not, I've done this and most people have done this. You end up with a situation like that. You know you're front of the queue, so you leave the order there and go, well, if it comes back, it will tick me and I can just take a tick out of it. Even if you don't want to trade that level anymore, you're like, yeah, but I can nick a tick, so it's fine. Or worse, it comes back and you buy 33, assuming it'll uptick you, and it doesn't, and it just sits there. You just bought 33 for zero reason apart from I thought I'd nick 34. So yeah, I wouldn't advocate that as a strategy.
And I suppose also if you're trying to nail the top of the perfect entry and you're not getting filled, that significantly skews your EV
Yeah.
over time, right? Because you're not getting filled on the trades where you should be making a decent amount of return.
That's something I learned from my mate who we started together, and I remember having a conversation with him one day where he got a trade where like the FTSE would do this little flush down and stall, and he'd buy that and it would typically tick back up. And he did the trade and he tried to hit it with 10 and he got filled 2. And he went tick, 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 straight back up like 10, 15 ticks. And he was annoyed about it. And I was like, what are you annoyed about? Like you had zero pressure on that trade. You just got filled in straight. So he's like, yeah, but if that trade goes wrong, I get filled 10 and stopped out. So I lose on 10. I've made money, great, but I've made money on 2. So the next one, if it doesn't work, I will lose more than whatever I made there, despite the fact it's taken 10, 15 ticks. You'll lose 50 ticks when it goes wrong. I was suddenly like, oh yeah, like getting filled is more important than the number of ticks you take. Taking loads of ticks on one lot, if you intended on getting 10, is not really that worth it. Or you've got to take 10 times the number of ticks to make that trade work over time. But yeah, that's what I'd be looking for. The other thing with these as well, when you're playing the pullback trade there, as kind of mentality thing on a trade like that is you have to look at that and go, the next phase is going to be slow. So if you expect it to do that move in the same way it did the first one, it's not going to do it. That can be quick, and then this is slow. The reason being, this is a liquidation, and that one's genuine selling. And that's the difference between the two. When people need to get out, they don't care about price. If you're genuinely trying to sell this, you're more price sensitive, so you can wait for better prices.
If you take so you do the first and you get out,
Yeah.
then you get the second opportunity, would you then target down to the bottom, or would you factor in where it's reversed?
I would, minimum target would be there.
Right.
So I'd be looking, yeah, go there. Realistically, I might have been able to stay in that one, because whilst that low is 05, the low of the range was 15. So in getting to 05, it never comes back above 15. So I'd probably be able to stay in that.
Yeah.
But that's the kind of one that I know that I would get spooked out of.
Yeah. It's only probably a couple of ticks, right? You think, okay, now
Yeah.
you can watch people out now to the.
Yeah, but the fact that it's still below 15, you can particularly if you've made money on the first. If you made money on the first, you sell here.
You're sitting on your card and book, aren't you?
Yeah, you're sitting there going, well, I could put your stop at 20. If it goes wrong, you're making 15 ticks.
Yeah.
Yes, you're giving up maybe 15 ticks of unrealized profit, but you're using the money you've already made to give yourself the chance at essentially calling this a flag and going, well, it's about that. I never one for measuring. I think I had a level at 86, somewhere down there. But yeah, again, once it does that flush, that would be my out on that flush there. No, it's just quick down. You go, well, that's the same as that. Give it up and get out of that one. So yeah, that's how I'd approach those ones.
And also to that point about exiting with like trying to obtain a maximum favourable excursion. Oh, like what's the level where it flushes down to? 72 or whatever?
This one down here,
Yeah.
80 or
80.
Just above 82. Yeah.
And what's the level above it?
That low.
Next one down, the next blue one down.
This one 02. Down one there, 90.
So you'd end up either getting out at 82-ish or 90, right? So you're giving up, if you don't get out on the flush, then you're going to give up 8 ticks probably by the time. If you do that over time, that ends up being a reasonable number of ticks that you're giving up by not getting out on the flush and hoping, and then eventually I'm going to get out anyway.
Yeah. It definitely comes down to what is your intention for the trade, because you could look at that and go, like say with this second wave down, you could look at that and say, well, no, I'm playing for the big one because we're below 15 now, I'm playing for it. But yeah, on that, unless that 90 is a significant level that you broke, incidentally, that 90 was just drawn on afterwards, like once these levels formed. So that wasn't there initially. If 90 was a significant level, then I'd go, well, you're through that now, stop at 92, see if it goes again. But then you're into what I call kind of like bonus trade, that if it happens to do 90, 88, 87, 50, wonderful, you're in a great place. If it doesn't, well, you're still getting out roughly where you were happy to get out.
Yeah.
Should be kind of the mentality around that one. Yeah, there we go. Right, I'm aware I do want to cover the bond auction one as well.
Thank you, that's really good.
That's all right. Got a question. When looking at market profiles and building hypotheses, do large volume days like yesterday add any more weight to that day's profile? Do you treat similar shape profile, shapes and distribution regardless of the total volume on the day? Okay, good question. Volume was bigger yesterday. It was not astoundingly large. Yeah, I think it did, oh, there you go, I can see it. 1.9 million. The average volume full session on the S&P is 1.4. So it was 500,000 more, but it's not exactly at a level that hasn't been seen very recently. Like that only goes back to the mid-July, and the volume on the election has been topped at least 7 times. So it's not astoundingly high, but it is decent volume. I do put more weight on a day that's put more volume in. I would view it as more, find a better word, more sustainable, more believable. So yes, yesterday's profile for a cash session, it's just a wide IB normal day, just without the balance in it. A typical normal day, you look for it to kind of do that and fill this area in, which it didn't. But broadly, yeah, I guess I would believe in that profile, if you will, in terms of what it's told me, that it is happy to be up there. It's done it with a reasonable amount of volume. For a cash session, the volume was good, but not astounding. Again, we had long period in the middle here. This bit was very light volume. I'm not surprised as well. I don't mean there's any point in overthinking it. I'm not surprised that you got a lot more volume within the first 2 hours of yesterday. It was the first 2 hours post-election cash session, so I'm not surprised at that. I'm not massively surprised that you got much more volume at the close either. But yeah, I put weight on that. Like the fact that you traded a decent amount of volume on a huge gap up and stayed up, I think is quite telling. Yeah, that's a pretty strong sign for a market. And since then, we've drifted on higher and we've opened the gap up, and so far we've not closed the gap. It could be gap, and off we go. Which, you know, if you're trying to be technical about it, you could call yesterday a breakaway gap, today an exhaustion gap. Doesn't mean that it has to go down yet, and we could stay up here and stay up here and stay up here. If you're someone who wants to sell, the dream scenario is that we stay up today and tomorrow you gap down and it leaves today's profile on its own at the top at a record high. That'd be like the technician's dream. Mike could be so excited if that happened. We'll see. It could, but Mike would be over the moon if that happened. And that would be one way I think you have to look at that and go, oh, you've got to try and sell that. That could be the record high for weeks if it happens. There you go. So yes, on the point of, I think I did this on the next one. Yeah, there you go. On the point again, coming back to structure, if I follow this on with looking at the S&P as well. What I've got here is a 60-minute and a daily. What I'm looking at is from a 60, it's clearly bullish, right? There's no doubts about that. We've gone up. What I'm always interested in is what's the point where I'd say in the sort of immediate term, it is going up as long as we're above X. And that for me is this red box here, which is 15 to 93. It's the kind of highs that we broke out on last week. It was the highs below that record high, similar to that 92s in the Bund. That was the only test above, whereas you got a test of the 15 over here as well, and then again and again. So to me, 15s is the level. So 15 to 93. If you're above that, it's going up in my view. If you get below that, then I think there is scope to try and retrace all of this. So you've got the move down to there. Overall, that doesn't change my wider view of where this is going, which is what takes you onto like the daily. On the daily, this is my kind of neutral zone. If you're above it, which is 58.27, which is around about here, if you're above that zone, I think we're still going up. So you could get a pullback all the way here, and I don't think that changes the wider view of the S&P. If you get below there, short term, I think you've got to shoot at these lows, and only then if you break 57, 27, 25. If you break that decisively, yes, I think it's going down. But until that point, I think any drop in the S&P is a buy. It's just the degree of the drop before you get the buy. That's how I always try and do that with markets, and just sort of layer short term, is there a trade? Because don't get me wrong, selling the break of 93 to get that move to 00 looks like a wonderful trade. Definitely want to be on that. If it goes 00, do I think it's going to go any further? Not necessarily. So be quite happy to go, well, that's fine. If it starts to trade back up, you can go for it. But you're going to have like slightly less conviction. It would almost be a case, I need to get back out of this range, get up here again, above 27, and then you can buy it again. So that's the way I try and sort of look at those types of things. Any trades in the blue box are short term, you're going from one area to the next. Above the blue box, any pullback's a buy, and below the blue box, it's a sell, and it's going down, and probably down here, which is 54.60. So I always just try and keep that in mind, just so that I'm never caught out if you start to get a solid directional move. You're like, whoa, it's overextended. If it breaks 57.27 and it drops 100 handles, I don't think that's overextended. It's the beginning of a bigger sell-off. So we'll see how that plays out in the coming days. Similar thing with gold. This is a 240 chart. So in terms of sort of structuring gold, that's, whilst it's hard to draw precisely and you'd have to draw the trend there, it looks like a pretty big head and shoulders to me. It's probably done the target already, so job is done, don't need to worry about it. It's now dropped you into this kind of what I would call neutral zone again, a bit like the S&P. If you're in here, it's about which way it comes out of that box. If it goes out to the upside, then you're back into this area here. Seems to be an area that it doesn't like to trade, and you could just get up and go straight back through that. It seems to not be interested in trading that. So you'd at least go to the other side, and then if it is, it will then fill the zone in. So it's a 27.30 to 26.90, that little area there. So you've got about 400 tick range that it could just get stuck and fill in. Or on recent form, it just gets in and goes straight through it. which is what it seems to like to do. To go down seriously, I think you could break that box, and I think then it could have a bit more of a serious drop in it. So it just gives a little bit of context for the Fed tonight. Incidentally, gold is now 27.01, so you're right in the middle. So I'm looking at that now, going into the Fed. I think you could look at that and say, well, any drop towards 28.90 is probably a buy. And have I got that on a short time frame? There you go. We're currently trading here. I think you could kind of look at this and go, well, any drop here is worth a go at a buy to play up, and any continuation, I said 27.29 up here is probably worth a sell to go back as well. And kind of in the middle of that zone is pretty ugly as to what precisely you want to do, but you can see then the move. That's basically the top of value. We're currently trading right here. If there's going to be a point that it's going to stop in the middle, that's where you've got the low volume and the single prints. So if it's going to be any point that it's going to give this move up completely and not go all the way through, it's probably there. And that could be it. It could just be a trend balance back down type day. I wouldn't rule that out actually. I'm not saying everyone go and sell gold 27 at 00. It's a sell, it's going down, but I wouldn't be surprised if that's the peak of the day. Right, last thing to go and talk about is bond auctions. I hope Joey's watching this on replay because this is going to be mind blowing. I'll send over a link which gives a good explainer of these. I will try and explain it as best I can. Okay, right, there's a few things that you need to know. The first thing you need to know is the snap price or when issued price. It's interchangeable, those two phrases. I think snap relates to European, when issued relates to American. It's the same. Basically, that's the price of the current bonds just as the auction starts, or better seen as yield. So look at the yield at the start of the auction. With treasury auctions, bids in the auction can be submitted from 15 minutes before the auction starts. So you submit your bids and there's your own issue price, and then people put their bids in. So all the different banks go, right, we'll pay X for the bonds. Some are going to pay above the when issued price, which means that you are getting a lower yield. You're willing to pay over the value of the bond, so you give up some of that future interest by paying a higher price now. You're increasing your chance of getting the bond. Others, not so much. They want it for nice and cheap, which means that they effectively get a higher yield on the bond. If the government can't sell them, let's say the bond's par value is 100, if they can't sell them all for 100, they'll sell them for 99. So the government effectively gives up some of that future interest, because they're still going to pay the same amount of interest, but they don't actually borrow as much money. So they're effectively paying a higher yield. So there's a few different bits of information that you get. They're all your bids. I can't remember the order I put all these little graphics on. Right, when the result comes out, what you're interested in is whether you've got the auction that traded through or tailed, i.e. did they sell them at a higher price than the when issued price. So if they've sold them at a higher price, that's termed as traded through, i.e. the yield will be lower than the yield on the yield before the auction started. So if the yield was 4.5 and when the results come out, it says that they sold them at 4.3, that's quite a big discrepancy, then you would have a traded through tail of 2, which is pretty big based on they're typically quite small. So traded through is good. That suggests people are willing to pay a higher price for bonds, shows demand. If they tailed, then they have traded lower than the when issued price, i.e. the yield is higher. People don't want them so much. That's a bad sign. So you're trying to judge bond demand. That's one of the most important bits of information. The bid to cover ratio, I don't know if I've got any, oh, there you go, no. The bid to cover ratio is not that important in American bonds or treasury auctions. Reason being, it can be manipulated to make it look very good. The reason why is you can bid, primary dealers have to bid in auctions. So if you're one of the, I think it's 21 primary dealers, they have to bid in the auction, right? So if they don't want it, they can bid really low, but bid a large amount. So let's say you're, in this instance, selling 35 billion of, I can't remember exactly, this would have been 10-year bonds, 35 billion of 10 years. If you're a bank who has to bid in the auction, you bid 3 billion. there's 20 other banks that are going to bid, quite possibly you get quite a lot of bidding for it. So despite the fact that you don't really want it, you can still make the auction look slightly strong by bidding a large amount. Equally, because treasury auctions are Dutch auctions, meaning that you don't get the price you bid at, you get the lowest available price. What this also means is if you do want them, you can bid way over because you definitely want the bonds. So again, you can manipulate it slightly like that because you know that there's no punishment for bidding a ridiculously high price, unless
it's going to get there. It's going to go to the next price.
Yeah.
Closest price to the right, to the right of the middle, and you're still going to get filled.
Yes. The only risk is nobody else does it, and now then the high yield is here, and you've just paid way over the money. But what it does mean is that people can end up. You're not going to bid a huge amount way over in case you do run that risk of getting them. But it'd be a lot of people who don't really fancy it, but still just put a bid in anyway of a reasonable amount just because they can. So the bid to cover ratio is not massively significant. Equally, if you want the bonds, you're willing to pay a decent price, you can also bid here as well for a large amount of them to make the bid to cover look good, despite the fact you don't want to actually get filled on all of those. So again, as long as you're not the only person bidding, you're not going to get them all. So the traded through or the tailed bit is important. The other part, so the two most significant things are the tail, as it's called here. So they're just terming this as a tail. So the tail 0.8, if it trades through, the tail is a negative tail, i.e. a positive trade through. The other thing that you're interested in is dealer takedown. This is the number or the percentage of the auction that the primary dealers have to buy. They have to participate. If nobody else does, the primary dealers get far more of the bonds. So the dealer takedown is really, really important to see, because that again shows you demand for people who genuinely want them rather than people who just have to buy them.
And the auctions that happen, you buy them through the cash mark. How do you buy them?
Direct.
A separate auction specifically for this?
Direct from the treasury, yeah. So their own, you and I can't just message. By the way,
where this stuff happens.
yeah, essentially, yeah. So this is done, the treasury allows people to submit bids. You put your bid in starting from 5:45. The results typically come out just after 6 o'clock. What this does also create, and the way that a lot of people, particularly European ones, will be traded, is you trade the flow rather than the result. Reason being, the people who are bidding in the auction have a rough sense of whether they're going to get filled. All banks talk to each other. It's not necessarily a collusive thing, but you know what other banks might want. So you get a good sense as to whether you're likely to get filled in the auction. So a lot of the time, by the time the results come out, most people who are actually getting the bonds know the result. I'll show you that on a chart in a moment. If you want to go and have a look at one of these and go and have a go at trading one of these, 25th of the 2nd, 2021 is probably the one to go and have a look at, and do it on T-note, so TY, oh sorry, not TY, that's my ticker symbol for it, ZNH 21. Go and have a go at it from 6 o'clock. I say 6, the result doesn't come out bang on 6, but try and spot when the result comes out and see if you can get on the trade. With this one, what you ended up with was a tail of 4.3, which is huge, as in people did not want those bonds, so they went way under. So they basically had to pay 4.3 basis points higher than the prevailing rate to get the bond sold, which is massive. And you had a dealer takedown of 40%, which is huge. That's probably the most dramatic bond auction I've seen. But when you got that, what you ended up with was that move. It sold off into it, probably partly because the people who are likely to participate in the auction have thought, nah, we don't fancy trading this one. We know that it's not going to be good because we know we're not going to bid in it, or we're going to bid really low. Probably other people are thinking the same, so you sell the treasuries ahead of time. Partly as well, that if you sell the treasuries ahead of time, when it comes to the auction, you're effectively pushing the yield down so that you can buy them at a lower price in the auction as well. There's quite a lot of gameplay goes on. There's like an objective to push the yield lower to get a higher snap price on the auction, or a higher yield on the auction. So then when you bid low in the auction, you're getting an even lower yield than, or sorry, an even higher yield than the now higher yield that you're already on.
So the price goes down, the yield goes up.
Yeah, so you can kind of just, where the Fed goes, all right, well, yields are currently 5%. everyone sells the treasuries, yields go up to 5.1. So when the auction comes, you're like, well, I'm not paying 5% on this. I want 5.2 to buy these bonds. So everyone then bids low to try and get that kind of reaction. But yeah, that was an absolute shocker. Worth a go. Have a go at trading it rather than me show you it and see if you can get on the trade. That's an absolute shocker and an absolute monster of a move on a treasury auction. That's what it was on a 1 minute. But I'll leave you guys to have a go at it. This was a 10-year from not yesterday, day before, yesterday. That's the results of it summarized. This is the way it comes out. So what you got, 42 billion of 10-year bonds at a high yield of 4.3. The actual result stops through, so by 0.2. So the implied is that the yield prior to this would have been 0.2 higher, so it'd be 0.2 basis points, I think, so 4.36. So it's not much, but they've got it slightly lower. So that's a good thing. Dealer takedown was 14%. You get various previews for these. If you've got the preview, you know what the previous dealer takedowns were. So one of the things you need to do is just keep a track of what the dealer takedowns are on auctions.
Change in the demand and supply pattern.
Yeah, so you know whether that's high or not. 14's about normal. I think you want to be worried if it goes over 20 and then you start to think, well, it's getting quite high. 20 and over 25, you're starting to think, yeah, that's getting really high. But like I say, you've got to kind of track those. Excuse me. The directs and indirects don't ultimately make a great deal of difference. I can't remember the distinction between the two, but essentially it's pension funds, mutual funds, hedge funds. I think the indirect is banks buying for a client versus the direct is the, PIMCO is able to actually participate in the auction, so they're a direct bidder rather than an indirect. Might be some, foreign pension fund buying via JP Morgan, so it's not JP Morgan's purchase, it's them acting on behalf of somebody. That was the result. It's not spectacular, but you get this sort of push up on the first minute, then this steady continuation. It only goes about 7 ticks, big ticks on the T-note. Bear in mind, this is T-note though. You could hit 2,000 lots and take 7 ticks, which is a lot of money. One of the things I was saying about the flow on these is you would often get this type of action where you get the selling of the bonds into the auction with the idea that that will push the yield up slightly. That's the first thing. It also is an action of pre-hedging. If you're a bank and you have to bid in the auction, you're going to end up with some bonds quite possibly. Now, you might not want them. Well, or you probably do want them because when a client comes along and says, can I buy some treasuries? You say, yes, we have got some treasuries. But you don't want the outright risk of owning the treasuries, particularly just before the election. So what they will do, they're effectively going to be long treasuries. They then sell futures, which hedges it. So the idea there being that whatever they expect to get, they hedge with futures. Part of the reversal can be the fact that some people may end up over hedging. They sell $1 billion worth of futures thinking they're going to get $1 billion in the auction. They only get $500 million. They've now got to exit that. So you end up with that type of thing. You also end up with the buying of the treasuries to match the demand in the auction afterwards as well. So a fair few different bits and pieces that go on, but the main bit with most of these auctions is predominantly just watching the flow. It's not a better thing necessarily, but it's sometimes an easier trade. I'm just going to watch the way this trades, and you see it start to pick up some pace, and you go with it. The general pattern is sell into it, buy out of it, is the standard approach to it. You can do this with Bund ones as well. As a rule on auctions, I wouldn't bother trading any auction that's less than a 10-year duration, because you need it to affect far enough up the curve. You don't want to trade a 2-year auction because 2-year bonds or treasuries are so liquid that whatever they sell just gets absorbed at one price. Darius, how does hedging not simply cancel out their position? That's the objective, right? So if I own a bond, what I can do is if I buy the bond, if I'm a bank and I buy the bond, so you now buy the bond price can go up and it can go down. Banks are not buying the bonds to speculate on the price of bonds as much as people think that's what they do. Banks don't make their money from speculation broadly, and regulatory, they're not actually allowed to anyway. Dodd-Frank Act 2012, for those of you who wish to know. So they're buying these bonds because the way banks make money is they can sell these to customers, and customers pay a fee. That's where they make their money. They can also use the bonds in some kind of structured product. I'm not going to go into complex swaps and options, but they can do that kind of stuff. So they own these bonds, but the price of the bonds can move. So if you're long bonds, actual bonds, what you can do is then sell futures, so ZN, and that now hedges you. If the bond price goes up, you lose on your futures, but you made on the bonds. If bond price goes down, you make money on your futures, you lose on the bond. The only issue that you have is you've got to maintain the margin to do this. So it sounds simplistic, but unless you've got the margin to sell enough futures to cover it, then you can't do it. So that's why. So the objective is to cancel out the position. You're not trying to take, banks aren't trying to take an outright risk on the bond value. They're trying to accumulate a position so that when a client comes on and says, I want some 10-year treasuries, they can have them. So there we go. Right, I'll wrap it up there, guys. I'll see you all tomorrow for the Fed. We're doing live trading floor tonight, actually, so if anyone wants to watch that, go for it. And then we'll see tomorrow what happened on the Fed, if anything. We'll replay at least the first bit of it, assuming something does happen. Right, see you all tomorrow. Best luck on the Fed.
And then in that scenario, Richard,